This lesson is going to cover the Wyckoff phases. We have 5 phases in any Wyckoff schematic, accumulation or distribution. And those are phase A, B, C, D, and E. So phase A is where the previous trend ends. Okay, so as you can see on the screen, phase A is where the trend ends and we move into what is a high probability range. Phase A is where we have our first shift of control from trending into ranging. This is key and it sets the path in motion for the whole structure that is to follow. It ends after the secondary test and it takes us into phase B. So you can see here that we have the buying climax, we have the automatic reaction, and then after the secondary test, that is when phase A ends, that's when we move into phase B. The reason that is your first shift of control is for that exact same reason. Remember, control was with the bulls on the way up. Now, because we had a failed secondary test and we had a AR, we can say with high probability that the control is no longer with the bulls, it's now with nobody. It's neutral, it's sideways. Then we shift into phase B. Phase B is construction of the cause. Phase B is vital. Most traders mess up Wyckoff analysis by not correctly accounting for phase B. It takes time to build up energy for the next move. Here, it's important to remember the second law of Wyckoff theory, the law of cause and effect. So, what we do in phase B is we construct the cause through ranging that will lead to the next effect, which is a trend. Proportionally, phase B should be longer than phase A or phase C. You see that on this schematic. You can see that phase A and phase C are much shorter than phase B. Time is extremely important in Wyckoff analysis. I can't stress that enough. The market needs to build up energy for the next move. It cannot just continue always in one direction, and it cannot just move from uptrend into downtrend immediately, because if it did that every time, you'd have a crazy looking chart. It's just not the way things work. Phase C, where we move next. So after we've constructed our cause, we now move into the test phase. So the nature of phase B is we're constructing a cause. We're building up energy, right? We then move into the test phase is because it's exactly what smart money are doing. They are testing the market. So before launching an uptrend at the end of an accumulation campaign, or before launching a downtrend at the end of a distribution campaign, the smart money will test the conviction of the bears or the bulls by either trying to push through the lows or push through the highs and seeing what reaction there is. If it rejects back inside or it fails to go above or below, they can be confident that the path of least resistance is in their favor. So in this example on screen, they try in the test phase, phase C, they try to push price higher above this high and they fail to do so. That shows that bulls are weak, and it shows that the path of least resistance is down because they tried to go up and it couldn't go up anymore. The path of least resistance in this case would be down, and so they know that the bear side can have more conviction and they can confidently launch into their downtrend movement, which they would do so through heavy selling. Important to note that quite often these tests will fail and smart money will realize it's not time to shift and that the original trend direction may in fact continue. Most of what you've seen up until now has been these idealized versions where it reverses. But of course, this test could fail, meaning price goes higher, right? And that happens. It's all about being able to interpret it in the moment. But after phase C, we move into phase D. This is now the trend within the range. This is where we have trending through the range and also the breakout with confirmation. This phase tends to happen pretty fast because of what happened in phase C. And so because phase C was a failed attempt for the bulls to reclaim, it means phase D, the market is starting to realize which way it needs to head. The smart money already knows, but at this point, most people are starting to get wise to it as well. And so selling increases on a distribution, the market moves down sharply, and of course in accumulation, this is where you trend aggressively through the range higher, because bears are giving up or bulls are giving up, and they're giving in to say path of least resistance is now fixed. We get the breakout, we get the confirmation, and then we shift into phase E. Phase E is where we trend outside of the range. So phase D, we trended through the range and broke out. Phase E, we trend outside the range, which is really what we're looking for this whole time. This is the effect that the cause of phase B built. You remember I said in phase B, it needs to be longer because they have to construct a cause. This is the effect of that cause. And the magnitude of this effect will be proportional to the magnitude of the cause that preceded it. So the longer it can build its energy, the greater you can expect this move to be in phase E. At this point, you want to think of the Titanic heading for the iceberg. At this point, it's too late to stop it, and the trend is clear. That's what you're looking for. That is where we want to trade. Late phase D, early phase E to catch the next new trend. So those are the Wyckoff phases. Keep those in mind. They are all important. They are the reason why so many people trade Wyckoff incorrectly, why so many retail traders who try Wyckoff lose money. They don't understand their phases. They don't understand why they work, what they exist for, and they don't pay attention to them. Learn the phases, understand them, and then we move on to the next lesson.